So, why the lack of consensus on a seemingly obvious... Have you ever wondered why the sky is blue? That seems like a random question, but it's a good analogy for how most people see a Federal Reserve decision. They focus on the big, obvious blue headline, the interest rate cut. But the real story, the economic storm coming for your wallet, is hidden in the invisible currents of the Fed's balance sheet. Last week, the Federal Reserve concluded its latest FOMC meeting, and the media focused on a predictable consensus move, an interest rate cut. The Fed funds interest rate is now down by a quarter point, resting at 4.0%. As an analyst, I told you to expect this. It's the easy, visible lever they pull. The real pivot, the one that confirms the money printing machine is warming up, was buried in the fine print. This is the moment we predicted, the beginning of the end for the tightening cycle, and the start of a countdown to trillions of dollars in new liquidity hitting the system. The source of this bombshell isn't a rumor. It's a direct quote from the Federal Reserve's own website. What the world missed is that the committee decided to conclude the reduction of its aggregate securities holding on December 1st. That is the technical jargon for ending quantitative tightening, or QT. Think of QT as the Fed sucking money out of the financial system, a massive year-long effort to shrink their balance sheet. On December 1st, that effort stops. It is over. On December 1st, why does that matter to you? Because I've laid out the roadmap before. First, the interest rate cuts. Then, the immediate quiet end to quantitative tightening. And finally, the inevitable turning on of the money printers again, likely by 2026. This entire sequence is a giant, flashing warning sign that inflation is going to come roaring back with a vengeance. The Federal Reserve is cornered. They have run out of politically palatable options, and every data-backed decision they make confirms their direction of travel. Now, let's go beyond the decision and dive into the highlights of the press conference, where Chair Jerome Powell faced a barrage of questions about the next shoe to drop, December's meeting. Before the press conference, the CME Fed Watch tool indicated a massive 92.8% chance that the Federal Reserve would cut rates again in December. But when Nick Timiraos of the Wall Street Journal directly asked if a December rate cut was a foregone conclusion, Chair Powell pushed back hard. Powell stated that a further reduction in the policy rate is not a foregone conclusion, and that the market needs to take that on board. This is the Federal Reserve trying to pump the brakes on a runaway market, reminding individual investors and institutions that their actions are not yet certain. He revealed there were strongly differing views within the FOMC itself. So, why the lack of consensus on a seemingly obvious follow-up cut? The answer reveals the fundamental tension inside the central bank. Some Fed participants believe they are already where they need to be, that the current rate level is in the neighborhood of the neutral rate. The neutral rate is the theoretical interest rate that neither speeds up nor slows down the economy, and many estimates of it live in that 3 to 4% range. Powell admitted that the committee is above the median number for the neutral rate, but that there are still people on the committee who have higher estimates. This is a deeply academic, yet profoundly important debate about the neutral rate because, as Powell noted, it is a number that cannot be directly observed. It is a belief, and that belief dictates whether they see the need to cut further or hold steady. The next major concern Chair Powell was forced to address was a simple, yet crippling problem: the data drought. The Federal Reserve insists it is data-dependent, making decisions based off the labor market and inflation data. But with the ongoing government shutdown, the gold standard government labor market data is unavailable. Howard Schneider from Reuters asked if the Federal Reserve worried about having to start making policy by anecdote without the official numbers. Powell's response was telling. He said they will collect every scrap of data they can find, but then he used a classic analogy. If you're driving in the fog, you slow down. This means the data drought is a legitimate reason for them to be more cautious about making a move in December. The Federal Reserve may not get the data flow they need, which would create an argument to hold steady simply because they can't see. Powell admitted that the situation could be argued both ways. One side would argue to slow down due to the uncertainty, and the other would argue that since things haven't obviously changed, they should stick to the September plan. Regardless, their mandate remains. They will have to do their jobs one way or the other. Percent inflation target. The Federal Reserve supposed. The next critical revelation from the press conference centered on the 2% inflation target, the Federal Reserve's supposed holy grail. With inflation accelerating globally, the question is simple. Is the 2% goal still credible, or is the Fed preparing to quietly move the goalposts? Chair Powell was definitive, stating, "We're absolutely committed to returning inflation to 2%. He claimed that longer-term surveys and market pricing prove this is a credible commitment and that there should be no question where they are going. But for an analyst like myself, that statement rings hollow when compared to the reality of the geopolitical forces shaping price levels. This brings us to the quiet tax on the American consumer, tariff inflation. One reporter directly asked Powell if American households should expect inflation to continue rising this year because of tariffs. Powell conceded that tariff inflation is real and will continue, but he minimized its long-term impact. His expectation is that it will be moderate and transitory. Here is his reasoning. The tariffs take time to work their way through the production chain and reach consumers, which is what we are seeing now from the tariffs put in place many months ago. The effect will continue for some time, likely into the spring. But Powell classified these as modest increases, suggesting they are only a tenth or so on overall inflation. He is saying the overall inflation rate, which sits around 2.8%, might only get an extra 2 to 4 more tenths added to it. The key phrase he used is that these tariffs cause a one-time price increase. The theory is that once all the tariffs are fully implemented, prices will stop going up. They will just settle at that new, higher level. At that point, the measured inflation rate will come back down to the non-tariff inflation rate. The logic is seductive, but the stakes for your personal finance are massive. Powell is effectively confirming that a permanent, higher price level for certain goods is now locked in. Your dollar will not recover the purchasing power it lost to those tariff-driven price increases. This isn't just theory. This is environmental economics meeting geopolitics. Every policy decision made in Washington, D.C. is adding friction to the global system, and that friction is paid for by you at the checkout counter. Now, let's go back to the trillion-dollar question. The money printing pivot. Powell is now confirming the roadmap to a new phase that follows the ending of quantitative tightening on December 1st. Over the 3.5 years they were shrinking the balance sheet, the Fed's securities holdings declined by $2.2 trillion. Relative to the size of the U.S. economy, the balance sheet has fallen from 35% to about 21% of nominal GDP. That sounds like a lot of tightening, but the most important sentence in the Fed's new plan is this. In December, we will enter the next phase by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower. He kept the duration of this pause vague, saying it will be for a time. Why the ambiguity? Because the Federal Reserve is waiting for a breakage in the financial system. Money printing is not an event they schedule on a calendar. It is a crisis response. When something significant breaks a major correction in the housing market, a sudden liquidity crisis in the banking system, or a dramatic spike in the 10-year Treasury yield that will be the signal. The pause is merely the calm before the next storm, an acknowledgement that they have to stop the tightening process before the entire system seizes up. This is a crucial analytical distinction. The Fed is not pausing because the job is done. It is pausing because the systemic risks of continued tightening are too high. The next move is always a shift from risk mitigation to crisis intervention, and crisis intervention always involves the rapid injection of new money. The ultimate challenge for Chair Powell was connecting these complex financial systems to the reality that everyday investors face. Pervasive financial unhappiness. He acknowledged that people are unhappy about the inflation situation, and it's not just because prices are still going up. It's because the prices from the inflation of 2021, 2022, and 2023 are still much higher than they were before the spike. For the Federal Reserve is to lower rates until the Federal Reserve sees the world through the lens of data and models, but you see the world through the price of groceries and the size of your mortgage payment. Chair Powell attempted to bridge this gap, but his message confirms that the financial pain will linger. He said that while it's nice that prices are not going up as fast as they are still much higher than they were just a few years ago. He believes it will take some time for the effect of past inflation to wear off. The mechanism for this relief? Real incomes must rise to catch up to the elevated price levels. Only then, he suggests, will people feel better over time. But this is the crucial part. That's going to take time. This is the Federal Reserve's quiet admission that the purchasing power you lost in the last 3 years is not coming back quickly. The problem is structural. Higher wages put upward pressure on prices, which means wage growth can prolong the very inflation it is meant to solve. It is a slow, grinding process of economic realignment that tests the patience and resilience of the American household. So, let's put the full puzzle together. The Federal Reserve just confirmed 2 massive shifts that override the temporary news of a rate cut. First, the tightening is over. The decision to end the quantitative tightening cycle on December 1st means one massive source of upward pressure on interest rates is gone. This is the invisible pivot that opens the door to trillions of dollars in new liquidity in the coming years. They are removing the emergency brake because they know the economy cannot handle any more tightening without a major systemic break. Second, the commitment to 2% inflation is likely a narrative tool. While Powell stated the goal is credible, the tariffs he confirmed are adding to a permanent higher price level for American consumers. The reality is that the new higher floor for prices, confirmed by the Fed's own analysis of tariff effects, makes returning to the old price trajectory extremely difficult without triggering a devastating major correction, a scenario the Fed will always step in to prevent. The immediate ambiguity about a December rate cut is simply the Federal Reserve buying time. They are driving in the fog because the government shutdown has deprived them of the data. But the long-term signal is clear and undeniable. The path of least resistance for the Federal Reserve is to lower rates until something breaks and then turn on the money printers to bail out the system. This cycle of rate cuts, followed by a pause, followed by a $1 trillion liquidity injection, is the defining pattern of modern central bank policy. It's not a question of if the money printing begins, but when it does, and all the data points to 2026 as the start of the next massive wave. The stakes for your financial future are defined by this pattern. Inflation is not a blip. It is a permanent increase in the cost of living that will take some time for real incomes to overcome. Understanding this economic fog, and the Fed's lack of options, is your best defense against the coming economic reality. Your strategy must adapt to a world of persistent high prices and the inevitable return of aggressive quantitative easing.